But I think that's a great opportunity for brokers, especially if you manage multifamily, to get involved with some of the hedge funds that are buying these, because they're going to need brokers to manage these residential properties for them. They call them horizontal apartment buildings. They have 100 by 100 homes in a city, and then they'll manage those for 5 years as rentals. They don't pay you much to manage them, maybe $50 a month, $100 a month, depending on the price range. You do have to advance money like an REO for utilities and stuff to get, once you get them rented and whatever, and wait to get reimbursed. But the quid pro quo is if you had 50 or 100 of these that you're managed for the next few years, every year maybe 10 or 20 of them will come to market. So you'll have built-in listings for years to come. So I think that's a great opportunity.
As long as the listings are part of the deal. You know, managing 50 roofs, managing 50 units under one roof is a lot easier than managing 50 units under 50 roofs.
And Matt, did you want to comment on that question?
Well, I think it was pretty well covered. The disposition of assets, the way I see it, the local, smaller, the mid-size.
Would you talk a little into the mic there?
I'm sorry. The smaller and the mid-size local banks, I think, are doing a pretty good job of cleaning up their balance sheets. As the CMBS, it's a storm that's he's still gathering steam. To pick up on what Ray had mentioned, I think your chart ended at 2014 or 2015.
Yeah.
If you look at the CMBS originations in 05, 06, and 07, those were the most aggressively underwritten loans, a lot of them with interest-only components to them, so there's been very little principal pay down. Those loans are going to be hitting the system 2015, 2016, 2017. There's going to be a ton of product out there to play for.
And Matt, I want to start with you on this next question so we can come back with the panel here, but it's on the same subject. What would you say, are we in an improving distressed property environment or a declining distressed property environment, and why?
I'd say, all in all, it is improving. Like I said, multifamily is very strong. Low caps, low vacancies, NOI growth. Industrial, again, very strong. Office is improving. Retail is improving. So all in all, I would say it is improving, and but there is still going to be a consistent flow of in the bank's eyes, over-leveraged properties that they want to dispose of or get off their books. And a lot of these loans are current, but they're going to have maturity defaults coming up. And that's where the problem lies, and that's where the opportunity may be.
And Wolf, would you touch on that a little bit, and why you think that's either declining or improving?
I don't know that I can add a whole lot. I go by what market trends that I read through CCIM mainly. Overall economic growth, maintaining steady pace, demand for space positive across all property types.
I'm sorry, could you speak up?
I'm sorry, okay. I lost my place. Well, anyway, to back up one point that we and I guess, just from personal experience, the people that I see that are distressed are the ones, and I think this has been sort of explained, in depth, is that are the ones who originated loans, back a few years ago and who over-leveraged. I think that, as I understand it, there is a resurgence in CMBS lending taking place. So going forward, I see it as improving, but I think we still carry a big load from before with us. And so I think those are, that's what we're talking about right here. I think overall the economy is, we're seeing, economic growth, demand for space across all property types, supply remaining in check, declining vacancy rates, rising rents to some extent. So that's.
Thank you, Wolf. Appreciate that. And John, you want to speak on
that? I would say that, just from my experience and speaking to other people at other banks in similar positions that I have, the amount of bank-owned, and not CMBS, but bank-owned distressed real estate is declined considerably. And the distressed or, troubled loans are fewer. being worked out and extended. In terms of, if you just look at the property from a real estate perspective, is it improved? I would say a lot of the things that were said, before are true. There are some improvements in certain sectors and specifically in, better markets. But there's a lot of situations where really we've just reset the bar. It went from a $30 million shopping center to a $12 million shopping center.
Good point.
And there's just a different ownership entity. All the fundamental problems that existed are still there. So, if you look at just headlines and they say, oh, the banks are getting through distressed property, the world's better. Well, it's not really. Drive, through neighborhoods and look at storefronts.
So, John, are you talking about, when we talk about, the different classifications of a $12 million property and a $30 million property, we're talking about institutional and then
No,
private?
I'm talking about the same property that maybe
I got
6
that.
years ago someone paid $30 million for
Right.
and put a $25 million loan on it, and we foreclosed and have since written it down. We wrote it down to 18 and then subsequently less, and then we actually sold it for only 10, and so it's reset the bar. So the property, if you look at headlines, okay, banks don't have any distressed property anymore, the world's great. Well, it's not. You still got that property that's a non-performing real estate asset.
Great
That's
point.
going to require a lot of expertise by an investor or operator and additional capital. And you hope things get better in terms of, economic demand drivers to support it.
Okay.
But you don't think that it's performing relative to the new price?
Exactly. It's reset the bar,
Yeah.
right?
Yeah. It's reset. And Ray, would you like to speak on that?
Yeah, well, we have different sections here. First of all, you've got the banks, and then you got the CMBS market. The banks have done a better job at writing it down. They did a better job at underwriting to start with, because their default rate's only 2%. So, the banks have done, I think, a better job at moving their inventory through than the CMBS market did. Realize the CMBS, you have different investors, and you have A, B, C, D, which is, it's all one mortgage, but it's equivalent to a first, second, third, fourth, fifth. And when somebody has equity, if you're in the fifth position and your equity gets wiped out, then the people in the fourth position are the ones that control the decision as to whether to liquidate or to negotiate. And so you always have, but the guys in the A position, they just want to liquidate it because they're going to get 100% of their money. Okay, so there's these kind of class wars going on between these groups, which slows down the whole process there. Where the banks, there's somebody like John that can make a decision and do something without having everybody sue him. So, so that's the kind of difference between those two. But also commercial and residential is different. Commercial, it's mostly just been extending it, giving them another year to work out and whatever, and that seems to be working for them because they're getting more profits or higher prices now. In residential, again, it's split between the Fannie and Freddie, which owns about half of the residential mortgages in the country, and the banks. The Fannie and Freddie, I think their plan now is that they're just going to sell the notes in bulk. They've, in a lot of areas, like in Florida, they've got like 300,000 zombies that are just sitting vacant. We're talking about single-family homes. In California, it's not so much, especially areas like where I live in Westlake Village. We have very few REO properties. It seems like the bank, especially I think Wells Fargo, one of my friends was a consultant for you guys, that were hiring a lot of loan originators this last year, at least the first part of the year. They had plans to hire 17,000 new loan originators. And it seemed like their plan, as well as some of the other banks, was to use the HAMP program to refinance underwater people. Realize that you can get a loan for 125% of the value of the home, and so if you're less than that, they don't have to write down to take REO it and take 80 or 90 cents on the dollar. They can get over 100% of that value by refinancing it. Plus, when they refinance it, it's insured by FHA. So now they get a performing loan, FHA guarantees that if it does go into default. But the big problem with residential mortgages today is we still have, and I've heard different numbers, between 10 and 16 million homes that are with negative equity in this country. And if you look at the actual people that are going into default 30 days or more delayed, 90% of those are coming from this pool of people that are upside down. The people that have equity in their homes today, the foreclosure rate is about half of 1%, which is normal in a normal economy. But as long as these prices, that we have all these people upside down with their mortgages, every year they have to, move up because they had a baby, they have to move because they lost their job, or they relocated, or they want to retire. And so every year of the 16 million, about 1 million of them are defaulting on their loans. And so, and we're not even bringing 1 million to market this last year. It was about 800,000. So we still have this growing, and I think the attitude of the big banks is that we're going to force these prices up, because every time we get the prices up another 10 or 20%, that knocks another couple million that are upside down and potentially going to go into default sometime in the future. So that seems to be the force. I'm telling people, buy single-family homes today, because I think the banks and the government have all decided they're going to push them back up to, because that's the only way to really solve that residential foreclosure problem, is to get these prices back up and get these people out from being underneath.
Okay, Ray, and we're going to start with you on this next question, because we're going to get into the really, what I call the dirt, the nitty-gritty stuff here, okay, which is, what do you see as the worst hit commercial real estate sector, and what are your thoughts as why?
Okay, well, that's going to surprise everybody, and I did get some information from TREP. I haven't got a recent one, but in '09, when I started this, the one that was the asset class that was the worst were hotels, lodging, and in '09 we had 19.6% of the hotels were not making their mortgage payments. So when you drive down the street and you count 5 hotels, one of them didn't make their mortgage payment that month. So that was the worst, and the multifamily was the best. It was about 5 or 6%, which was not really bad. As of November last year, those are kind of reversed. Lodging is, again, these are national figures and CMBS figures. Lodging was down to 12% default, and multifamily was the highest defaulted asset class, 30-day late mortgages or more, and it was up to 14.21%. This has dropped a little this last year. They're not putting out some of these, or at least I didn't find one, the same chart. But so the answer to your question nationally, and again, it depends, multifamily is the most distressed asset class today.
Mm. And John, would you give us your...
I got to qualify this by saying that my responses are not going to necessarily represent core Class A properties. So I would say that you've got to remember that most REO is not Class A institutional investor property. Okay, it's older B property, C property, in smaller markets, sub-markets, et cetera. So I would say that office has been really hard hit, and where there's a plethora of it, it's pretty hard to figure out and do any kind of economic analysis and make an educated guess at when you're going to have any absorption if you have an empty building or a half-empty building. And older, strip retail, unanchored is also tough, but there's a lot of money flowing into those assets.
Mine is just gleaned from general CCIM market knowledge, and my understanding is that retail and office were the hardest hit. Retail is recovering as stock market does better and the economy is recovering. Office, at least around here, my understanding was that it's 15 to 20% vacancy rate. I learned this morning that maybe it's between 12 and 15 right now. I think those are the hardest hit. I think if multifamily were to be the most distressed, it's maybe in a sort of very hypothetical way, looking forward based on the current valuations. If things, investors' projections don't pan out, more so than, you know, anything that I can actually see right now or see looking back based on, you know, what's going on. I think that's all I have to say on it.
And Matt?
The hardest hit commercial sector, in my opinion, is the tertiary market, the outlying areas where there's been little or no job growth. If you don't have jobs, your retail is going to be weak, your office market is going to be weak, and Palmdale, Lancaster, Riverside County, San Bernardino County, Central Valley, Modesto, Stockton. These areas they're hard hit. They're recovering very slowly, if at all, and I think that's where most of the distress is right now.
Okay, now let's flip the coin there then, and I know a couple of you mentioned it, but let's start with you, Matt. What do you think the best sector is right now, where we're seeing the most improvement, and why?
Well, most improved, I would say, because multifamily took the least hit, and it's the strongest sector. I don't know if that qualifies as the most improved. I think the hotel sector is the most improved. After the financial crash, you had virtually all corporate functions cease and desist, banquets, award vacations, conferences, everything just, you know, grinded to a halt. Of course, the recreational travel took a big hit. So, you know, going from a stop to, you know, where we are today, I think that's the most improved sector. It's you're starting to see some hotel construction slowly coming back, especially in core central business district areas and by airports. The limited service, the Holiday Inn Expresses, the Courtyards, things like that seem to be doing much better. So I think that's the most improved sector. There is a lot of properties that are going to be able to be picked up in the REO sector that were just way too over-leveraged at the height of the market. So that's my opinion.
Okay, Wolf?
My understanding is that hospitality is the most improved market sector. It's not my area of expertise or strength. It's just what I've read. I think multifamily has been very strong. I think, though, that we're seeing, you know, market indices pointing to cap rate increases going forward. So it's been holding very well, but it's unsure. I'm unsure about where it's going to go. You know, just judging from a single listing that I have, I do think there is a lot of interest in retail, that people are in certain areas. I recently listed a shopping center, a bankruptcy listing, and had, you know, 10 offers within a few days, and I had to take it off market. So I do see a lot of a really strong interest in retail as well.
Thank you, Wolf. And John?
Yeah, I would echo both of those sentiments. You know, hotel and retail they're both asset classes where you need to reinvent and reinvest and sell to your customer every day to drive rents. And there are a lot of new format, fresher concept hotels and renovations that are occurring and have been occurring. And, you know, if you look at REO, if you look at those older, stale properties, I mean, drive up Atlantic or, you know, Long Beach or whatever, and look at them, it's like, do they really need to be there anymore? And the answer is probably no. But overall, I think that sector is improving, and retail is as well. Part of why retail has been improving so much in terms of prices or investor interest is a lot of these investors over the last several years had been focused initially on multifamily, and the yields got so low they jumped to another asset class that, you know, most of these investors really don't understand, because retail has complexities, you know, that are different than multifamily. But in any case, a lot of money has jumped to them, and you know, values have increased.
Okay, and Ray, do you agree or disagree in the sectors being the most improved? And then give me some